Hello, everybody. How's everybody doing today? Dan, how are you? Great to see you. Thank you
Good,
very much for joining us.
good to see you too.
Today, as everybody knows, we're happy to have Dan Habib and possibly Barry on with us to talk about how to master this crazy market for loan officers and specifically for real estate agents. As many of you may know, Go Mortgage and PacRes recently merged. You may know this, Dan. I hope you do. To
Hmm.
create a new, bigger, and stronger powerhouse in the mortgage industry. Our deal is now closed and our focus is on growth. And hopefully, what we learned today, Dan, will help us make some decisions on how we grow as this crazy industry continues to navigate this interest rate environment. Dan, many of us are MBS subscribers and have been for a long time. I was truly on the ground floor when Barry started MBS Highway. I remember meeting you in New Jersey. I think you were in diapers. Wasn't that long ago. And MBS Highway has so many incredible tools for loan officers. And after this, Dan, we got to get on the phone and we want to schedule some time for you and possibly Barry just to walk our whole team through all of the functionality and all the tools MBS has. Because if you're a loan officer today and you're not using MBS Highway and you take your business seriously, you're going to be losing out to your competition who's just going to know more about what's going on than you do. I can't imagine, doing what I do without watching MBS Highway every day. I follow the bond market sort of like my blood pressure, and recently it has been elevated, right, Dan? So it's been an interesting market, but really grateful to have you here. Grateful to have you and MBS Highway, you Dan and Barry as partners here, and really excited for what we're going to talk about today. So next, I'd like to bring up one of our national head of sales, Dave Bergstrom, who also has been an MBS subscriber for an eternity. And he's going to introduce our guest today, Dan Habib. Dave?
Yeah, thanks a lot, Michael. I appreciate it. Dan, welcome as always. So, yeah, I think I was an MBS Highway subscriber probably when Dan was in diapers as well. And soon to be, Dan is going to have one in diapers. So, Dan, that's coming up later this month, right? So,
Is any day
yeah.
now, Dave. If my wife calls, I apologize ahead of time, but I have to answer just to make sure she's not in labor.
Sounds great. Well, good morning, good afternoon, everybody. And thanks again for registering for the call today. We want to welcome our originators, our real estate professionals, and all other guests at PacRes Mortgage and our affiliates, and Go Mortgage, of course. We believe we have a really insightful and timely webinar today focusing on mastering the market in 2025. And Dan's been an educator in the industry for over 15 years. He was recently honored by the National Mortgage Professional Magazine, being named one of the top 40 under 40 mortgage professionals in the country. I remember those days, barely. He was also presented with Housing Wire's Rising Star Award, which acknowledges young leaders in the housing industry. He is currently the head market analyst and chief revenue officer of Highway, which is the parent company of MBS Highway and List Reports, which provides the mortgage and real estate industry, is one of the most trusted providers of insight for the industry. Dan's also the co-founder of Crypto Charged, a platform designed to educate investors on the crypto markets to help them make better informed investment decisions. And today we have a packed agenda. And Dan, we got to start doing better with planning for this. It seems like every time we have you on a call, the market tanks. So it's okay. We're not going to blame you. So today's going to focus on a forecast for 2025, including a deep dive into inflation, the labor market, the Fed, interest rates, real estate, of course, showing clients the opportunity in the housing market, and tools to beat your competition and gain more referral sources. So with that, Dan, I'm going to turn it over to you. And thanks again for joining us and welcome.
Well, thank you guys so much for having me. It's certainly an honor to be on with all of you. Michael, great to see you. We've known each other for a long time. You and my father have been good friends, and you're someone I've always looked up to. And, Dave, you've always been a good friend. So everybody listening on the call, and Lando, hi to you as well. But everybody listening on the call, I get a chance to talk with and deal with mortgage companies across the country. And I got to say, you guys are lucky to be working with such a great group, with such great leaders in this now powerhouse coming together of PacRes as well as Go Mortgage. So, want to just say thank you guys for having me, but also I'm excited to break down what's happening in the market for you guys because there's a lot going on. And Really want to take it step by step and go through what we might be able to expect this year. I know it's been challenging the last few years. Do have a bit of an optimistic message for you today, but we're going to take a deep dive on what happened last year because we do forecasts every year, see how we did, but also what to expect for inflation, the labor market, which are going to be key drivers for mortgage rates as well as real estate, and a deep dive on the Federal Reserve. So let's jump right into it. And as we do, as Dave mentioned this morning, we do see, mortgage rates getting a little bit worse. And that is because we got a little bit of a hotter inflation reading for the month of January, higher than expected. Now, we are recovering a little bit. We're off of our worst levels, but that was a surprise to the markets, which they didn't like. Inflation is something that is key. If you think about it, inflation is what the Fed is looking at as far as whether they should cut rates, whether they should hike rates, whether they should pause. But it's something that you and I feel every single day. Inflation, simply put, is how much are prices of goods and services rising? And they tell you how much it's changed month to month, but the big numbers are the year-over-year numbers. Now, you guys know, and I think everybody feels, the cumulative inflation that's been taking place. You hear somebody like myself or other economists out there saying how inflation is starting to cool and it's decelerating, but you might hear that and say, I don't know what you're talking about because I don't see prices getting any cheaper. And you're right, they're not. There's a difference between the cumulative inflation that we all feel, which is over the last several years, prices just going up and up and up, and the rate of change or the current inflation rate. So unless you have a negative inflation rate, make no bones about it, prices are still getting more expensive and are rising. It's just at a slower pace than they were previously. Now, the Fed's goal is to have prices only rise at 2% per year. But, that's kind of a number they came up with that they're comfortable with because usually incomes are rising at a greater clip than that. But we have had a period of time where inflation has been much hotter, and that is not a good thing for mortgage rates. If you want to just think of an example here, let's pretend that I was like, Dave, can I borrow $100,000? And maybe Dave said, sure, Dan, but I'm going to charge you what? A certain rate of interest. Let's say it's 4%, just to pick a number. Well, Dave is going to get that fixed return, that 4% return, over the course of the next 30 years, theoretically. And that fixed return he gets, initially, he can go to the store, go shopping, and let's say he could buy a list of goods and services. But if inflation is on the rise and you have prices rising, well, maybe a couple years down the road, he notices that that return doesn't go as far because inflation has eroded that fixed return that he's getting from the loan that he gives me, especially a long duration or a long-term loan. So what's the only thing you can do in that scenario to protect yourself from the rising inflation? You have to charge a higher rate. It's really quite simple when you put it in that way, but that's pretty much how it works. So if inflation's rising, usually mortgage rates are rising. If inflation is falling, the opposite is also true. So with that, let's go ahead and jump into it and really break some of this stuff down together. So as I mentioned, deep dive here on the Fed, interest rates, and housing. And oftentimes people ask me, Dan, what is the fastest way that I can increase my income? And while there's no silver bullet, I certainly believe that if you close more of the opportunities that you already have, that is a really good way of increasing your income because without any additional resources or really doing too much different, if instead of closing, 5 out of the 10 customers that you talk to, imagine if now you're closing 7, 8, 9, think about how that exponentially increases your income. So how do we do that? How do we increase our conversion? Well, I think any relationship, but especially a sales relationship, trust is always paramount. If you think about scenarios where trust is intact, think about how smooth, how easy and quick things go. It's beautiful. But think about a relationship where there's no trust there, even maybe a personal one you've experienced. That makes things very difficult. It bogs things down, makes things very challenging. So trust is always important. So how do we build trust? Well, listen, there's many ways, but 2 that I always like to point out that I think are highly effective. The first one is vulnerability. Now, vulnerability can be a tough one, especially for people that, maybe they think that's showing weakness. They don't want to, show that weakness. They might think the customer may not want to work with them, but it truly is one of the best ways that you can build trust because it really shows that, let's say I'm going to try on some jackets. I'm going to the store. the salesperson there that is going to be telling me that every single jacket I put on looks fantastic, I'm not going to necessarily trust them. I know all these can't look great, but the one that actually tells me something negative, the one that says, you know what, that one doesn't look too good. It's kind of hugging the belly there, the Lebans, the hips. I wouldn't pick that one. They're telling me something bad, but I trust them more because they're putting what's best for me ahead of their own commission. And it's no different in our business. Maybe it is not the right home for them to purchase because of the neighborhood it's in, or because the forecasted appreciation in that market really isn't looking too good, or maybe it's not the right time for that refinance. So vulnerability can be key because they really trust you because you're putting what's best for them ahead of your own commission. And it's really like, instead of sitting across from the table from them, you're putting your chair next to them, almost like if you were advising your friend or your family member. Now, the other really, I think, critical way of building trust is with market expertise or with knowledge. Especially in today's day and age with artificial intelligence and technology, information is literally everywhere. But knowledge is still a valuable commodity that people are willing to pay for. But you can't fake knowledge, right? You have to put some of the work in. But if you want to be magnetic, leave people after talking with you feeling good and feeling smarter. Right? People gravitate towards or want to work with somebody that they perceive to be an expert and somebody that's put in the work, somebody that is a master of their craft. And that's a lot of what we're going to go over today, giving you some market expertise so that in your conversations with your customers, your referral sources, you can really sound smarter than your competition and be able to articulate what's happening in the market and how that may influence or impact mortgage rates or housing. And we're going to go through some predictions today, but I always like this quote, as Yogi Berra says, it's tough to make predictions, especially about the future. So listen, not always going to be right, but let's go through what we predicted last year and see how we did, because I think we did pretty good. So we thought home price appreciation was going to be somewhere between 4.5% to 5%. If you look at the most recent data that we just got full year from CoreLogic, 4.5% nationwide appreciation, which is still very meaningful for wealth creation. I'd say that was pretty much a bullseye. We said the 10-year Treasury yield was going to be somewhere between, on the low side, 3% to on the high side, 4.4%. Actual came down to 3.6, and it did go a little higher than we expected to 4.7. On 30-year fixed mortgage rates, we thought we'd see it come down to maybe the mid-5s to the high 6s. Well, we got into just below 6% back in September, but it was short-lived, to on the high end, the low 7s. But I do believe that if we see mortgage rates come back down to 6%, that should unlock a lot of move-up buyers. I mean, we saw it in September, right? When rates came down to low 6s, high 5s, saw a lot more refi activity on the mortgage side, but also a lot more purchase activity. And I do think that we can get there as we're going to go through, which would obviously help activity to really rebound and move higher. And when we take a look at why we missed some of the forecasts on mortgage rates there, the main reason has to do with the jobs data out there. If you guys have been following along, the BLS, or the Bureau of Labor Statistics, every single month they release the big monthly jobs report. And it tells you how many jobs were created that month. It also tells you what happened with the unemployment rate, amongst other things. But the BLS, they are surveying 670,000 businesses. It's a sample. It is actually a small sample compared to all of the businesses out there. And there's certainly a lot of margin for error. Every time the BLS reported a jobs report, it was higher than estimates, and we saw the bond market sell off, and we saw mortgage rates move higher. It's actually quite frustrating because they then come and revise the numbers significantly lower in the subsequent 2 months. But then much later after the fact, you have something called the QCEW that comes out, Quarterly Census of Employment and Wages, which is the actual data. And there has been some really big revisions. So if we look at what the BLS reported for all of last year, they reported 2.5 million jobs were created. But if you take a look at what some of the forecasts are for the QCEW data, which is going to be released soon, it's expected to only show 1.25 million jobs. Now, instead of just a sample here of 670,000 businesses, they get data from 12 million businesses. It covers about 97% of all the jobs in the U.S. Interestingly, this is from the BLS too, but they're projecting half the jobs that were initially reported by the BLS. Now, imagine if every single jobs report on average last year we saw 100,000 less jobs than what was reported. Obviously, mortgage rates would be a lot lower, and you guys would have seen activity in real estate respond as well. So it can be quite frustrating. However, we're going to go through the labor market in detail. I do see some signs of some cracks. I do think that we can see that unemployment rate start to move higher. And some of these numbers kind of shake out and true up because, boy, 50% of the jobs not occurring from what they initially stated, that's a pretty big miss. So let's talk about inflation. We discussed the importance of inflation. Obviously, we feel it as prices are rising, but it is one of the main drivers of mortgage rates, and it's one of the main things that the Fed is looking at. I believe, and we at Highway believe, that inflation is being significantly overstated right now. Now, I don't want you to forget the cumulative inflation is still there. So prices have not started to come down by any means, but the rate at which they're going up in the reports that come out, like this morning's Consumer Price Index report, or the Fed's favorite measure of inflation, which we'll get at the end of the month, PCE, or personal consumption expenditures, we believe those are overstated from what they really should be. And one of the big reasons is the shelter component. Now, remember, the Fed's target is 2% inflation on a year-over-year basis. So prices rising in aggregate by 2% per year. The latest reading we got from the Fed's favorite measure of inflation was 2.8%. So it's come down quite a bit. They've made progress, but that is still too hot and well above the Fed's target. But the main component, the biggest single component within these inflation reports is something called shelter. Now, this is the cost to put a roof over your head, but it's not what you might think. It doesn't include home prices, but rather it's rent. So how much rents are going up? And that's blended rents, new rents, and renewal rents, as well as something called owner's equivalent rent, where they actually ask homeowners how much they would rent their home for and compare the changes there. Now, I don't know about you, but I don't know how accurate that can necessarily be. I think that most homeowners probably wouldn't be in the market unless there may be a realtor and know exactly what their home would go for. But this is the methodology that they use. And it makes up almost a fifth of the entire report. So the way shelter goes can certainly influence overall inflation readings. Within the PCE report, it's showing that shelter is rising at 4.7% per year. But if you look at some more real-time reliable numbers, CoreLogic, they're only showing blended rents, that's new and renewal, going up at about 1.5% per year. So that's a pretty big difference. That's a 3.2% overstatement. Now, the reason why shelter within these inflation reports is not reflective of what's really happening is there is a very big lag. The numbers are finally starting to slowly catch up, but they are not indicative of what we're seeing in the actual market because of the way they calculate it. They're averaging numbers over the last 12 months. They're also only looking at samples of rents every 6 months. So there's some reasons why that's lagging behind, but you can calculate where inflation would be based on shelter being caught up. If you use the real-time numbers, well, you could see that based on the 18% weighting and the 3.2% overstatement, core CPI, the Fed's favorite measure of inflation, is being overstated by about 0.6%. If you caught it up, core inflation would be 2.2% without that shelter lag. And that would be pretty close to the Fed's target. If we saw that, the bond market would certainly have a rally and a party. But we do believe that that is coming. So that is some good news. But right now, it is certainly lagging behind. And if you just look at some of the different sources out there for changes in rent, Realtor.com covers new rents. They're reporting on a year-over-year basis that new rents are down 1.1%. And of course, with a vacant new rent, you have a higher propensity to discount price because it's vacant and you have a carrying cost there versus renewals. Well, that's something that it's a pain in the butt to move. So you have a little bit more pricing power there. You have the person already in the home. So Realtor.com, new rents down 1.1% on a year-over-year basis. If you look at Zillow, their renewal rents up 3.4%. If you look at Apartment List on renewals, on new rents, down 0.5% year-over-year. Well, if you were to take Zillow's renewal rents and blend it together with Realtor.com, you only have blended rents going up 1.25% year-over-year. And if you take a look at Zillow and Apartment List, so Zillow's renewal rents and Apartment List new rents, it's 1.5%. And if you take a look at CoreLogic, which just reports a blended rent, it's at 1.5%. So you can see that all of these different real-time, more reliable sources for how much rents are actually going up or down, you could see how they're all pretty in line. And what's being reported in these inflation reports that the Fed goes off of is clearly overstated. And because of that big weighting of shelter, it's overstating inflation as a whole. And you could see how it compares with the government's data. Shelter up 4.4% year over year. And you look at PCE up 4.7%. But we are starting to see the monthly shelter readings. This is the shelter component. We are starting to see them trend lower and finally showing signs that they are beginning to catch up. So our inflation forecast for this year is that we think we're going to continue to see shelter catch up. We think that's going to cause inflation, especially on the Fed's favorite measure, core PCE, to move lower from its current level of 2.8% down to somewhere between 2.1 to 2.3%. And we think that makes a big difference for mortgage rates. We think that that also could change the Fed's outlook for how many times that they want to cut rates this year. We just heard from Powell. He just testified yesterday to the Senate, today to the House. And one of the things he said is that right now they could be patient with cutting rates further. However, if we see the labor market weaken unexpectedly, or if we see inflation come down more than anticipated, then they can cut rates accordingly. So the Fed can change their mind, and they can change their mind very quickly, depending on the data that comes out. Let's take a look at the labor market, because the labor market, it was showing an unemployment rate back in 2023 of about 3.4%. And you could see it's been rising. So we've seen some more weakness slowly over the last couple years. Most recent report, the unemployment rate did decline from about 4.1% down to 4%, but it is more elevated on a relative basis. We do think that this number will begin to increase. And one of the reasons is that once people are laid off, it is much harder to find a job. We're seeing firings at pretty muted levels, but look at the median duration of unemployment, meaning how long people are staying unemployed before finding a new job. It has increased 21% over the last 7 months. So what this is showing us is that once you're laid off, there's less hiring going on and it's harder to find a job. So we believe this is going to show up in some of the job creation figures. And how about just job openings? So this is how many job postings, how many openings are out there that companies are saying they want to hire people for. Well, you can see back in 2022, the peak was about 12 million job openings. Look at how that's really come down. It's currently 7.6 million. And this number, I believe, is very overstated. This was an article recently in the Wall Street Journal. Fake job postings are becoming a real problem. They're estimating about 20% of jobs advertised are fake or not filled, according to some of these reports here in the Wall Street Journal. Well, there's something else that's going on too. It's hard to compare figures today versus several years ago because we had COVID. And you know that since COVID, there's been a lot more work from anywhere, which means that a company could post the same job in multiple states and it gets counted multiple times because they don't need to be in that location. They could be working from home. So there's definitely some double counting as well as some of these job postings that are happening. So we don't think the labor market is as strong as the published data from the BLS is stating. And in fact, we think we're going to see a lot more negative revisions as we get the updated QCEW data. And we think the unemployment rate is going to rise this year from its current level of 4% to somewhere between 4.5% to 4.6%. And this too, in addition with inflation coming down as we predict, will really be helpful for mortgage rates. Now, how does this impact the Fed? The Fed is key. The Fed is controlling monetary policy. And what that means is you've been hearing about the Fed cutting rates, right? The Fed since September, they've cut rates by 1%. You might be wondering, well, if the Fed cut rates by 1%, how come mortgage rates since that time have gone up by about 1%? Well, it's important to note that the Fed is not cutting mortgage rates. They're not even cutting a long-term rate. The Fed is cutting something called the federal funds rate, which is really a short-term rate. It's an overnight rate that banks use to lend to one another. But when they adjust this, it has a direct impact on some short-term rates. So your credit cards, your money market accounts, maybe some business loans, car loans, things of that nature. So it doesn't have a direct impact on mortgage rates. What's really going to impact that more is going to be inflation, the labor market, and also what the Fed is kind of saying about those things based on how many times they want to cut rates or if they want to pause. So it can indirectly impact mortgage rates, but not directly. And so far, we've seen mortgage rates go in the other direction. The Fed, at their last meeting, they released something called their SEP, or their Summary of Economic Projections. And as a part of that, all of the 19 Fed members, they say where they think the unemployment rate is going to be this year in 2025. And you could see here on this chart, 14 of the 19 Fed members don't see the unemployment rate going above 4.2 to 4.3%. And if you take a look at that, what does that mean? It means that if we saw a 4.4% unemployment rate, which it's currently at 4%, so if it rose to 4.4, 14 of the 19 Fed members would be surprised, they'd be taken off guard, and they likely want to get more aggressive with cutting rates and easing monetary policy. 5 members, the remaining 5, don't see the unemployment rate getting above 4.4 to 4.5%. So if we saw a 4.6% unemployment rate, well, that would surprise all 19 Fed members. So it's important to note that even though at the December Fed meeting, the Fed said, we're not going to cut 4 times anymore in 2025, we're only going to cut 2, which the market didn't like because it shows that the Fed's more concerned with inflation. Maybe they feel the labor market is stronger than previously expected. It doesn't mean that that's how many times they're going to end up actually cutting this year. We've seen this so many times throughout history where their projections don't even come close. So we do feel that even though right now the median forecast is for 2 rate cuts in 2025, we believe the Fed is going to end up cutting 4 times this year after all, because inflation is going to come down a little more than they expect, and because the labor market is going to show some more weakness than they expect. So we're anticipating that from the current Fed funds rate, which is in a range of 4.25 to 4.5, the effective Fed funds rate splits the difference there, 4 3/8. We think you're going to see it come down to a range of 3.25 to 3.5, which would be an additional 1% of cuts. And additional Fed cuts, while so far they haven't done so, we think they can also help to push mortgage rates lower. And this is how it can indirectly impact mortgage rates. Now, first off, if they were to change their forecast from 2 rate cuts to 4 rate cuts, it would show that they're more comfortable with inflation, which we know is a main driver, as well as a little bit more fearful of the labor market. So just that in itself can help. However, so many investors took advantage of more money market rates that were available. Remember when the Fed hiked, 5.5% or so? Well, that caused short-term rates that are directly impacted back in September 2024 to be at about 5.5%. So many people said, boy, risk-free return, almost like having it in cash, extremely liquid. Why not take advantage of a 5.5% risk-free return? Well, that's come down to about 4.5% because the Fed has cut 1%. Remember, this short-term rate is pretty much directly impacted as the Fed cuts. Well, let's look at the current 10-year Treasury. Actually, since I made this slide, it's gone up a little bit today. It is 4.63% right now. Well, guess what? I mean, it looks pretty attractive eventually for investors to begin to buy some protection or buy some duration. Because we know as the Fed continues to cut rates, money market accounts are going to continue to come down. So instead of waiting to have that return evaporate as the Fed cuts, especially if they cut, 4 more times this year, why not go ahead and lock in that higher yield in the 10-year? So instead of maybe getting 4.5% today, boy, you can get a pretty similar number and get that for the next 10 years, which may be much more beneficial than waiting for that short-term rate to continue to fall as the Fed cuts. And we haven't seen this really start to happen yet, but we believe it will begin to happen. And we think that that money going into the bond market, into treasuries, can also help to push mortgage rates lower. So this is an indirect way here that the Fed cutting rates can eventually help directly mortgage rates to move lower. So let's talk a little bit about mortgage rates. Mortgage rates, I want to give you a forecast, but I don't want to just tell you a number. I want to really walk you through our thought process on how we get there. So the 10-year and mortgage rates, they always have a relationship. Mortgage rates are almost always a certain amount higher than the 10-year, but the 10-year can have big influences on mortgage rates. Now, listen, mortgage rates come directly from something called mortgage-backed securities, but the 10-year is a pretty good barometer and one that I want to set a target with, and then we'll talk about the relationship with mortgage rates. So 10-year Treasury currently is around 4.6%, let's call it. But you could see that back last year, we got down in this range here of 360 to 380 on the 10-year. And just looking from a technical perspective, and we also got there back in 2023, we think that as some of the things unfold that we're expecting, we could see the 10-year Treasury come down and test some of these levels this year once again. So let's talk about the relationship between the 10-year Treasury and 30-year fixed mortgage rates. There's always what we call a relative spread, which means that mortgage rates throughout history, if you look at this long-term chart and you look at these two green bars, mortgage rates are usually somewhere in the neighborhood of 1.6 to 2% above or higher than the 10-year Treasury yield. But there's periods of time, like you could see in like 2009 here, you could see right after COVID, and you could see more recently in October of 2023, where this spread or this difference really widens. And back in October of 2023, 30-year mortgage rates were 3.1% above the 10-year Treasury. Well, since that spread has come down a little bit, but let's talk about why this happens. So part of pricing a mortgage, there's many things, is the servicing value. You have servicers that literally service the mortgage. So they send you your statements. If you're late on a payment, they send you a nasty letter, and they receive a fee for doing so. And if mortgage rates are higher, you can oftentimes see that servicing value be completely depleted because what is expected to happen? Well, it's expected that that loan is not going to stay on the books for very long because as soon as mortgage rates come down, what is the customer going to do? They're going to refi out of that mortgage into the lower rate. So when you start to see rates move higher, like we saw back here in October 2023, which is when you had 8% mortgage rates, there is very little, if any, servicing value in that loan. And because that value is no longer there, it can cause the spread between mortgage rates and the 10-year to get wider than it normally would be. But once mortgage rates start to come down, and obviously they've started to come down from 8% on a 30-year fix, right? You'll see servicing values begin to re-enter because as rates come down, there's less prepayment risk. And that's why the spread has narrowed from about 3.1 to 2.5%. So how low can mortgage rates go this year? What is our forecast? I wanted to kind of walk you through the thought process. Well, again, we think the 10-year can get down to a range of 3.6 to 3.8%. And the spread, as rates come down, we think will continue to narrow from its current spread of about 2.5% to 2.25%. So what does that mean for mortgage rates? We think you could see, on an optimistic side, if we get a little lucky, somewhere around 5 7/8 or so to the low 6s. So we think you could see it get back down to some of those levels that we saw back in September of last year when we know that that really sparked a lot of move-up buyers, created a lot more activity. You don't have to see rates go down to 5% to see that big increase in activity. We already saw it in September. We know the demand is there. It's just that it was short-lived. So high 5s to low 6s are our target for mortgage rates at some point this year. Now let's talk a little bit about real estate. If we look at the entire U.S. housing market, there's 136 million households. And of that, 45 million are rented and 91 million are owned. And if we look at the rented, obviously they don't have any equity in that home. And if you look at the owned, the total equity of those 91 million households is 37 trillion. So the average amount of equity that these households have is about 407,000. If you look at how many owned homes are owned free and clear, meaning without a mortgage, that's 35 million. Total equity is about 20 trillion. So those people owning homes free and clear on average have $571,000 in equity. And of the mortgage properties, which is 56 million, the total equity is 17.3 trillion or 311,000 average equity in those homes with a mortgage. And if you look at how much of that is tappable, meaning you could pull cash out and still retain 20% equity in your home, it's right around 210 or so thousand. So people's household balance sheets that own homes is very healthy, right? And it's part of the reason why you see foreclosures and such much, much lower than they were years ago. So people have a ton of equity in their homes. And one of the things I like to look at is demographic patterns. And this is a chart here of the generations. You got your baby boomers, your Gen Xers, your millennials, your Gen Z, and you can see the current age. That's kind of like an accepted range for all of these different generations, what the population is, what the current home ownership rate is, and then what's the home ownership rate when they were 30 and then when they were 40. So I like to look at this because I truly believe that demographics is destiny. And if we look at the millennial category, there's 73 million people in total in that group. The median age is 35 years old. Well, the home ownership rate for millennials on average is 45%. But what about when you look at those with a median age of 30? There's about 40 million of those. The home ownership rate is 33%. But over the next 10 years, you should see that home ownership rate rise from 33% to 55%, meaning you should have 8.5 million more homeowners or 8.5 million more people that will need to find homes. So you could have over the next 10 years a lot of demand coming just from that millennial age bracket based on home ownership rates that exist there. And how about Gen Z? Gen Z, there's 69 million people in total. The median age of Gen Z is about 20, and their home ownership rate currently is only 8%. Well, over the next 10 years, if they were to follow the path of the millennials, you should see that home ownership rate increase from 8% to 33%, or a jump of 25%, which would mean you need 17 more million homes for these individuals. Now, not all of them are going to buy them as individuals, many as couples. They don't necessarily have to follow the pattern, but from a demographic standpoint, you should be seeing a lot more housing demand over the next 10 years based on history. And if we look at supply and demand, which in my opinion almost always determines price, we are seeing supply not keep up with demand. Let's take a look at the demand component called household formation. So what's that? A household formation, here's an example. You have mom, dad, and child living at home in one household. Well, the child grows up and they then move out of the house to buy or rent a home. Well, you have the same family, but now you have an additional household. A new household has been formed. Or you have a couple living together in one household. They get separated, and now one of them has to move into a different house. You have a household being formed. So those are household formations. That is your demand component. Well, if you look on an annualized basis, household formations right now are 1.9 million in the United States. Let's take a look at supply. Now, we have pretty good visibility into supply because you don't blink your eyes, and all of a sudden a home is created, right? First, you have to permit it. Not all those get done, by the way. Then you have to start it and break ground, and then you have to complete construction. So we know that if you look at starts, that's a pretty good indicator because, as I mentioned, permits, some of those may not even come to fruition. But right now, starts are in a range of 1.3 to 1.6 million, and the latest number is 1.49 million. So if you look at active listings, boy, active listings, they've gone up about 25% over the last year. You've heard this in the media. Oh, we have supply that's really increasing. And while it's true that it's increased, it's always important to get a little bit of a benchmark as to how is this relatively speaking, because if you look at what a normal market would be pre-COVID and you look at how many listings there were, we're down still 25% from 2019. So yes, over the last year, we've seen an increase in inventory, but we are still much lower than a more normalized market. And also since that time, we've seen the population in the US grow by about 12 million. So if you look at supply and demand, which we're going to put this together in a second, supply is not keeping up with demand. And there's also some opportunities that I think exist right now due to seasonality in home buying. So if you look in January of the last few years, this is a chart of home prices according to the Case-Shiller Home Price Index. Now, we know we've seen some really good appreciation over the last several years, but you always see around January, February, you see a bit of a lull here in the winter months as home prices usually cool off a little bit during that time. So we do believe that you will see home values increase once again this year. I think now is actually a very good opportunity ahead of the spring home buying season, where you start to usually see home values begin to rise at a bit of a greater clip. And again, supply is not keeping up, 1.4 million with demand, which is household formations at 1.9 million. More demand than supply, we think, will continuously add appreciation and increase home values. And of course, if we see mortgage rates come down, that's going to spark even more demand, and you could see some even greater figures. So we think this year we're going to see appreciation nationwide. Of course, it could vary from different markets, but nationwide, somewhere between 4 and 4.5% appreciation. So is that exciting? Is that something that your customer is going to be excited about? Well, if you don't break it down and illustrate it and quantify it for them, 4% doesn't sound like that much, right? But if they were to purchase a $500,000 home and we saw 4% appreciation, you'd get $20,000 that you would gain over the next year alone. If we saw 4.5% appreciation, it'd be $22,500. And the 5-year cumulative forecast, which we're blessed to be a part of a prestigious survey out there of the top 150 housing analysts in the United States. This is put together from Fannie Mae, Zillow, and Pulsenomics. You take a look at what the forecasts are of the top 150 housing analysts. They believe that we're going to see over the next 5 years cumulatively somewhere between 30 and 35% appreciation, which is in line with our expectations as well. So just to quantify over the next short 5 years based on the forecasts, if you bought a $500,000 home today, well, if you saw 30% appreciation over the next 5 years, you'd gain $150,000. If you saw 35%, it'd be $175,000. So I think it's critical to break down this financial opportunity out there for your customers. So just to recap some of our forecasts for this year. Unemployment rate, we think it's going to rise from the current level of 4% to somewhere between 4.5% to 4.6%. And remember, if we see that happen, it's going to surprise a lot of the Fed members. If we see core PCE inflation drop, we think it's going to fall from 2.8% to somewhere between 2.1 and 2.3%, and that should help mortgage rates. If we look at the Fed, what are they going to do with their federal funds rate? We think they're going to end up cutting this year 4 times, and it's going to end up in a range between 3.25% and 3.5%. And we think mortgage rates are going to move lower from around 7% today to the very high 5s to the low 6s, which will spark a lot of activity. And we think home price appreciation is going to be somewhere between 4 to 4.5%, which is still very meaningful for wealth creation. And by the way, if you guys want to keep in touch, I post a lot of good content on social. My Instagram handle is @DanHabib. And remember, we talked in the beginning here about the fastest way to increase income. One of that is with market expertise, right? Having wisdom versus information out there and how to win versus your competition. Well, certainly by being able to articulate some of the things that we talked about today, that will definitely show that you are the expert and leave the customer feeling like, what am I going to miss if I don't do business with this person? But on top of that, the mortgage professional that invited you to today's call from PacRez and Go Mortgage, they are plugged in to what's happening in the market. A lot of times you might not have the lowest rate out there, but what's more important, if you have the lowest rate or if you actually get the customer executed at the lowest rate? And the market's always moving. I mean, to look at today, case in point with mortgage rates moving a bit higher after the little higher inflation reading this morning. So the mortgage professional that invited you to this call is plugged into the market, and you could see how they've done with some of the market moves that we've seen and some of the volatility. They have been able to expertly maneuver what's happening with mortgage rates and protect your customers and get them executed at the best possible rate, thanks to being tracking mortgage-backed securities and being on highway. But now, listen, we just laid out a picture for why we think mortgage rates are going to trend lower this year. So naturally, I'm sure you're already hearing this, but if you were to tell this to somebody, what would the customer say? Well, why would I then buy today? Why don't I wait for mortgage rates to come down before purchasing? And in order to overcome that, I hear many people say, you should marry the home and date the rate, which means buy today, but then when rates come down, we could refi you into the lower rate. And that's all well and good, and that's a cute saying, but if you don't quantify it for them, it really just is a cute saying. So here's what I would do in the way I would break it down. For every 1% drop in mortgage rate, It's estimated from the NAR, National Association of Realtors, that you have 5 million more eligible buyers. And listen, not all of them are going to buy, but some of them will. And that is going to make the tight inventory scenario even tighter, lead to less choices, and it's going to apply more upward pricing pressure. So, in some ways, the higher rate can actually be their best friend counterintuitively. And then I would break down an example for them. So let's walk through one together. Let's say a customer is looking to potentially buy today a $700,000 home with 20% down. So the loan amount will be $560,000. Let's say the rate is 6 7/8. Their total monthly expenses would be $5,075. Now, conversely, maybe they say they want to wait a year and they think rates over the next year might come down by 1%. Well, let's say they're right, even though there's no guarantee of that. And let's say rates come down 12 months down the road to 5 7/8. Well, you'd have some savings because of the lower interest rate. Your total monthly expenses would be $4,893. Not as much as you might think, though, because what people don't contemplate is we are expecting appreciation over the next year. And we have the forecast for every single zip code in this market that I pulled up. It's 4.1%. Well, that means that that property is going to appreciate in value. And if you still want to put 20% down on that home, you're going to have to borrow more money and take out a higher loan amount. But there is a cost of buying today and dating the rate. It's $182 a month more expensive versus waiting a year for that 1% lower rate. And over the next 12 months, you're going to spend an extra $182 a month each month, which means it's going to cost you an additional $2,184. But remember, when rates come down, let's say you're right, and in 12 months they come down by 1%, we're going to refinance you into that lower rate. But there's a cost for that too. It's $3,500 in this example. So if you put this together, the cost to date the rate is $5,684. That sounds like a pretty expensive date. But the benefit of marrying the home is that you're going to see 4.1% appreciation over the next year. And that $700,000 home would rise in value by $28,700. So if you put this together and you subtract out the cost of dating the rate, by buying today with rates higher and then refinancing when they come down next year, you would be better off by a little over $23,000. You don't want to wait, and this is exactly why. And this is the kind of stuff you need to be explaining to your customers to get them to commit today. And your Pac Res Go mortgage professional that invited you to the call, they have access to all these tools. They can pull this up for any of your scenarios with your customers, with your listings, and all this stuff can be branded and co-branded. So make sure you engage and reach out to them because this is something that can be very impactful and help you to increase your conversion. Another way that they may be able to help is with the lock-in effect, which I know many of you are experiencing. And this is where a customer has a low mortgage rate. And even though they might want to move into a more expensive home, because rates are higher, they can't bridge that gap. They get sticker shock. It's just too much of a jump, and they have the lock-in effect. But it's important to take a look at all of their debt together because even though they might have, let's say, a 3.25% mortgage rate, a lot of consumers today are riddled with debt, a ton of credit card debt, car loan debt at much higher rates. And if you go ahead and do a blended rate exercise, which the mortgage professional inviting you today can do for your customers, you'll find that when you add in the vehicle loan, you add in the different credit cards, in many scenarios, their blended rate may be much, much higher. In this case, about 6.5%, not too far off from where 30-year fixed mortgage rates would be. So in a lot of cases, you probably experience this when you have a customer that is looking to sell their current home and then do a move-up purchase. And we know people are having needs, right? Maybe they had a child or they want a basement or a home office after COVID. Most of them take all the proceeds from the current sale and put it down towards the new home because they think that'll give them the lowest loan amount and the lowest payment. But they might be better suited because of their blended rate analysis here to take some of those proceeds and pay off their debt and take out a higher loan amount. And you might be able to narrow that gap instead of, let's say, $2,500 a month. Maybe it's $300, $400, $500 a month more expensive when you look in totality at all of their debt after consolidating a lot of it. And maybe you'll be able to get them over that lock-in effect and get them into that new home of their dreams. So something I would be taking a look at, not going to work obviously for all your customers, but you can get creative and look at consolidating some debt. Now, How about buy versus rent opportunities? I hear from realtors all the time saying that it's tough to overcome customers wanting to rent out there. There's all these articles in the media saying it's cheaper to rent in every market in the country. Now, yeah, if you look just at the monthly payment, maybe that's true in some markets. However, let's go through an example because you have to look a lot deeper than that. Let's say somebody's looking to buy a $500,000 home with 10% down. Let's say the rate is 6.5% and their monthly payment's $4,204. Well, a comparable rent in this market would be $553 a month cheaper. Now that's where the media stops. Cheaper to rent. But we know, looking at blended rents, we know new rents are negative, but renewal rents, they're on average somewhere between 4 to 5%. In this market, it's 5% on the renewal. So this customer wants to be in the home for 9 years. Let's throw in some other negatives. Remember, the vulnerability is a great way of building trust. Well, let's point out some of the things they should look out for. Property taxes, they rise. Let's put a 2% escalator. If you buy the home, you're going to be responsible for the maintenance and repairs. Based on the home value, let's say that's $2,500 a year. And when you go to sell the home, you're going to use a realtor. It's a 3% cost to sell. And if we look at the appreciation historically in this zip code, it's 4.2% over the last 63 years per year. The forecast, which we have for every market, well, over the next 9 years, it's expected to be on average 4.1%. So just under what we've seen historically in this market. So let's go ahead and look at the analysis here. If you look at just the cash flow first, yes, it's $553 a month cheaper to rent. But let's inspect those monthly payments. The bar on the left is your monthly payment to buy. The bar on the right is your payment to rent. Now, based on that rental renewal increase, if you look, it gets pretty close by year 4. By year 5, it actually becomes more expensive to rent. But let's also factor in principal, because the principal portion of your payment, which is this black shaded area, that's not really a cost. That's kind of like your own money. And if you factor that in, boy, by year 2, it gets close. By year 3, it actually gets more expensive to rent. So if we look at the total cash flow of renting versus buying, in this scenario, over 9 years, you're actually a little bit better off buying versus renting cash flow wise. And remember that principal we talked about. After the first year, you gain $5,000 in equity from that principal payment. After 9 years, almost $60,000. And over the 9 years, as you pay the loan down from $450 to $390, you're going to gain almost $60,000 from amortization in equity. But how about the 4.13% forecasted appreciation? Is that significant? Well, it's life-changing because that $500,000 home would increase by about $220,000, and it would be worth around $720,000. And there's also a tax benefit above renting. Now, of course, you need to do this the right way because everybody can take the standard deduction. So you have to see if there's a delta or a difference of taking the mortgage deduction versus the standard deduction. In this case, it's about a $16,000 benefit. And let's factor in the negative. When we go to sell the home, the 3% real estate commission in 9 years, based on the future appreciated value, is about $22,000 that we're going to have to pay. So when you put all this together, yeah, it's $553 a month cheaper to rent initially. But when you factor everything in and you look at all the components, after 9 years, you're better off by about $286,000 buying versus renting. Now, if you're going to be in the home for 1 year or less, you're not going to be able to overcome the cost to buy and the cost to sell. But if you're going to be in the home for longer than a year, it definitely makes sense to buy. And this is how you can really have a mic drop argument over buying versus renting and really educate your customer as to why they might not be better off renting. And of course, all this stuff can be branded and co-branded with your PacRez Go Mortgage professional. And this is always an interesting exercise that I like to show people, and it has to do with net worth. So net worth is your total assets minus your total liabilities, gives you your net worth. So it's kind of fun to see where you may stack up, right? Top 1% of the US is 11.6 million. Top 2% is 2.7 million. Top 5%, 1.2 million. Top 10% is $1 million. Top 50% is 600,000. Now that's interesting, but what I thought was really relevant and the most interesting part of this is that on average, 2/3 of all this net worth comes from home equity. Very hard to get into these top echelons without owning a home. And back to the buy versus renting scenario we just did, 2019, homeowners on average had 40 times that the net worth of renters. You look to 2024, which is the latest year we have data for, that's actually 42%. So certainly much more lucrative and better from a net worth perspective to be a homeowner versus a renter. And what I want to leave you with is that, even though rates are a little bit higher today than we would like, I always like this quote from Sir John Templeton, and that is, the time of maximum pessimism is the best time to buy. And really, you can utilize the higher rate as your friend in these scenarios, especially the cost of waiting one, like we talked about. Articulate the financial opportunity in home ownership. Show your customers why you're the expert, and talk a little bit. You don't have to go as in depth as I did, but talk a little bit about what we see happening in the market, why we think inflation is going to be coming down, the labor market is showing some weakness, and why we see rates trending lower this year, but also why they shouldn't wait because of the financial opportunity, and how that forecasted appreciation will dwarf the interest savings. And then, of course, your mortgage professional can always refinance them into that lower rate when rates do come down, if they do. Team, I appreciate you guys having me on here. I think we got a couple minutes here left, Dave, in case you have any questions.
Yeah, Dan, thank you so much. Great information. And you've already redeemed yourself. We had a midday price change for the better a couple minutes ago. So there you go.
Fantastic.
Right. Yeah, the chat box is open, everybody. We did record this call. I forgot to mention that at the beginning. So we will be sending out the recording to everybody so you can review it again. But we do have a few minutes left. If anybody has any questions in the chat box, Mike, Lando, since you guys are live, you guys have any questions for Dan while we got him?
Not a whole lot of questions, Dan. That was incredibly insightful, awesome presentation. Really appreciate it. And encouraging a little bit, right? For the rest of the year. One of the things that you said earlier on, and I think about this every day, and we've talked about this on some of our calls, is, a year or 2 years ago, I think at some point we thought rates had to get back down into the fours before we'd really see a pickup in business.
Mm-hmm.
Then all of a sudden in September of last year, as you noted earlier, rates came down to the low sixes, where maybe you could buy, a point and get into the fives, 599.
Mm-hmm.
And all of a sudden we saw a 30% spike in volume. And that was not just refinances, it was refinances and purchases.
Mm-hmm.
And it just tells us that, looking at, your predictions, it appears as though it's realistic to expect that rates will get down into the low sixes, maybe even the high fives, even if just the spread in the 10-year, 30-year narrows. And if that happens, we'll see a big spike. And in addition to just what we saw last year, the way I feel, right, and we're already seeing it right now, it's not spring yet, but I almost see us pulling the spring market forward a little bit. We're seeing an increase in volume even today ahead of, the spring market. And I think that there are a lot of people out there, whether it's household formations or other, that they've waited long enough. Since
Mhm.
COVID, they've had 2 kids, they've got 3 kids living in the same room, and they're getting to that point of frustration where they have to do something. And so I'm expecting inventory to open up a little bit in the spring. I think we're going to pull the spring market forward. And if rates can come down a little bit, right, if we can narrow that spread between the 10 and 30 and get into the low sixes, I think we're going to have not one of our best years ever, but I think we're going to have a good year and maybe better than expected. So
I think those are some really good insights, Mike, and I think you're pretty dead on all of that. And as you mentioned, people are still having life events happen, right? So after a certain amount of time, I think people, like you mentioned, initially might have thought you'd have to see rates come down to 4%, because I think right now the number is like 55% of people have mortgage rates under 3%, or maybe it's under 4%. I'm sorry, but as time goes on, I think people get a little more comfortable with the higher rate, and they have life events that happen, and you don't need to see a change like that to see a big spike. And we have good evidence of it from September. It's just that only lasted for a few weeks before rates rose once again. But based on our forecast, I think we can see them come back down to similar levels, and I think that'd be a really good thing for activity.
I couldn't agree more, Dan. And it's funny. It's you hear 333 and 6 seems insane. You hear 77888 and all of a sudden 6 sounds good.
Yeah,
Some of it is just all up here, right?
Yep.
So it's a little bit of a mental
Boy,
game.
my father told me when he started originating, I think
20%, right?
they were like somewhere between 15, 18%, something like that. Yeah. So
Is that when he was selling
relative.
mortgages out of the back of his car?
Yeah, he used to sell he used to sell him a stereo and a mortgage.
Right.
Hey, Dan,
The
there's a
world
question
has
in here
changed
about
a lot. By the way,
what's
how's your dad doing? How's his health? Everything good?
Yeah, thank you for asking. You know what? Thank God. Um, he's doing really well. He feels great. You know, for those of you that don't know, my father's been battling cancer for the last year. It's been a bit of a challenging year. You know, chemo didn't work. Did some pretty cool like treatment called CAR T, where they program your T cells to target your specific cancer. And you know, we did this not too long ago. Took a scan, and he's in remission right now. The key is just to have what they call a durable response and have it stay there. So I think we got a pretty important scan coming up in the end of the month, maybe. And then the key is make it to 6 months and still have it stay that way. And then they give you pretty good odds of it not coming back. But it's obviously something you always have to monitor. But he's boy, he talking about somebody that's inspired me. I mean, my dad's always been my hero, but you know, I couldn't even get him to not be on the update, even going through all this, and he was still speaking. I mean, he spoke for 5,000 people. The doctor said there's no way he can be able to speak. I mean, he just he's incredible. So, but thanks
Well,
for
we're all
asking.
big fans. You know, he's been a good friend for a long time. I wish him our best. And again, we appreciate everything you guys do for us. Thanks, Dan.
Well, thank you guys.
yeah, thanks a bunch, Dan. It's great
Really
to see you.
appreciate you guys.
Best of luck with the baby.
Hey,
Keep us
thank you. I'll keep you posted, Dave. Any day now. I actually have a doctor's appointment this afternoon. Actually, pretty soon. I got to go run to. We're at the stage where you got to go every week now. So any day could be a live day. But oh, I saw Magda. I think asked a really quick question before I leave. Right. So on the new construction side, you know, what do you think about builders being able to build lower price point homes? Well, you know, I think there's certainly challenges there, especially with like carrying costs and you know rates. You know, they've come down 1% from the Fed and such, but uh, I think we certainly need more supply on the lower end there. But I think there's definitely some challenges. Um, you know, I still think that just overall we're going to see a lack of supply out there versus the demand that we see, especially if we see rates come down. So I think we're set up for another good year of home price appreciation, even though the media is probably going to say for the 10th year in a row that we have a housing bubble on our hands.
They said that 4 years ago, right?
They've been saying it every year, uh, but
Meanwhile, prices keep going up. So
right.
by now. All right. Thanks, Dan. Really appreciate your time today.
Thanks,
Yeah,
guys.
thanks,
Great to see
everybody.
you.
Talk soon.
Thanks a
Dave,
bunch, Dan. We'll
thanks.
talk soon. Take care.
Bye, everybody.